The car is gone. The loan is not. That's not a riddle. It's what a lot of drivers find out about 3 weeks after a wreck. The claim closes, but the balance doesn't. You carried collision and comprehensive, what people call full coverage. You paid every premium on time. The insurance company did exactly what your policy said it would do. It looked at the car, it cut a check, it closed the file, and you still owe money on a car that no longer exists. How does that happen? The answer is 3 words, and they're sitting in your policy right now. Actual cash value. Everything about this makes sense when you really understand those 3 words. Actual cash value means what your car was worth on the open market the moment before it was destroyed. Not what you paid, not what you owe, not what it was worth to you, what a stranger would have paid that morning. Picture a receipt in a drawer. Now picture a price tag on a windshield. The receipt represents history. The price tag represents today, and your insurance company only reads the price tag. Almost everyone has this backwards. Your auto insurance does not insure your loan, it insures your car. 2 separate contracts, 2 different companies, 2 different days. They were never introduced to each other. Your lender doesn't care what your car is worth. Your insurer doesn't care what you owe. Each one is doing its own job correctly in its own lane. The space between those 2 jobs is where your money goes. So that's one side, what the car is worth. Here's the other, your loan balance. That's where the damage happens. Picture 2 elevators in the same building. One is your car's value. The other is your loan balance. Both go down, but not at the same speed. Your loan balance descends in a nearly straight line, steady, boring, scheduled years in advance. Your car's value doesn't do straight lines. It started falling the day you drove the car home, and it falls fastest at the beginning. Kelley Blue Book puts the first year drop at about 20%, around 30% across the first 2 years. After that, it settles down to 8 to 12% a year. So you have a straight line racing a nosedive. That's the whole problem. For a stretch of time, those 2 elevators sit on different floors. Your loan is up here. Your car is down there. That distance has a name. Well, a few names. You may have heard it as underwater or upside down. The industry calls it negative equity. It means you owe more than the thing is actually worth. So how does this happen? 4 completely ordinary things. 1. A small down payment, or none at all. You start the loan already behind the car's value. 2. A long term. Term is just the number of months you'll be paying. Stretching them out is what makes each payment affordable. It's also what keeps the balance high for longer. Experian puts the average new car loan at just under 70 months. In early 2026, more than a third of new vehicle loans ran longer than 6 years. 3. Rolled over negative equity. Let's say you traded in a car you still owed money on. That leftover balance got folded into the new loan. 4. Extras rolled into the loan. Taxes, fees, a service contract, whatever else got added at signing. It all rides along inside the amount you financed, and none of it makes the car worth more. Each of those can be lawful and ordinary when it's properly disclosed, but each one does the same thing. It raises the amount you financed without raising what the car is worth. You never see that distance, not until the car is gone, but there's something built exactly for that distance, Gap. Not the stylish but affordable clothing store, Guaranteed Asset Protection. It's commonly written as an acronym, GAP. It's named after the literal space between 2 numbers. You'll also see Gap Waiver, Debt Cancellation Agreement, Loan Lease Payoff. The names aren't standardized, but the math is. So don't go by the label. Read what the contract actually pays. Let's say your car is declared a covered total loss, or stolen and never recovered. Your insurer pays actual cash value. Say that comes to $25,000. That money does not come to you. It goes to your lender. When you finance the car became the collateral. It's what backs the loan. If you stop paying, the lender can take it. So the lender has a claim on that car until the loan is paid off. Now the car is destroyed and the insurance money has taken its place. The lender gets paid out of it first. But you owed $32,000. So $25,000 goes against the loan and $7,000 is still owed on a car you no longer have. Gap is meant to cover some or all of that $7,000. That's it. That's all Gap does. One job in one situation. So where do you buy it? 3 places usually. 1. the dealership or lender, at signing, often as a one-time charge folded into the amount financed. 2. Your auto insurer, as an add-on to your policy. Or 3. A bank or credit union, selling its own version. When it comes from a lender, it's often not insurance at all. It's a waiver. The lender agrees to waive the balance. An insurance company agreeing to pay it is a different thing entirely. Here's why that matters. Insurance is regulated by your state's insurance department. If something goes wrong, that's who you call. But a waiver usually isn't insurance under state law. So that department may tell you it isn't theirs to handle. The refund rules can be different too, and all of this varies by state. Check yours. And if you're leasing instead of buying, check before you pay for anything. A lot of leases already include GAAP. Some require you to have it. Some sell it to you separately. Your lease agreement is the only place that tells you which one you've got. Definitely worth 2 minutes to find out. You don't want to buy something you already have. That's what GAAP does. The brochure stops about there. Remember, GAAP never pays first. Your regular insurance does. GAAP only covers what's left after that payment, which means GAAP can't work on its own. Say your car gets totaled, and you dropped collision coverage a year ago to save money. In that case, your insurer would pay nothing. So there's no first payment and nothing left over to calculate. And here's the part people get wrong. GAAP does not step in and cover the whole loan instead. It just doesn't pay. You'd owe all of it yourself. That's why insurer versions usually require you to carry comprehensive and collision. Lender waivers set their own requirements, but the idea is the same. GAAP isn't repair coverage. The car has to be a covered total loss. That includes theft, but usually only if it's never recovered or comes back wrecked. Was your car stolen on Friday but found Sunday and still drivable? Then that's not a GAAP event. And a $4,000 repair bill doesn't trigger GAAP either, even if you're upside down on the loan. GAAP doesn't care what your car costs to fix. It only applies when the car is gone for good. Your deductible is the part of the claim you pay yourself. It comes out of the insurance payment before anyone else gets a dollar. So go back to the example. Your car's actual cash value was $25,000. If your deductible is $1,000, your insurer doesn't send $25,000 to your lender. It sends $24,000, which means you don't owe $7,000 after the payout. You owe $8,000. Does GAAP cover that extra $1,000? That depends entirely on your contract. Some cover the deductible up to a limit, some don't. It's one sentence in your paperwork. Go find it before you need it. Depending on the agreement, the calculation may also leave out late fees, past due payments, interest that piled up after the loss, anything you added to the loan later, and some or all of the negative equity you carried over from a previous car. That last one is quietly ironic. It's one of the main reasons people are upside down in the first place. And GAAP contracts have a ceiling. There's a maximum they'll pay, and different contracts set it differently. So GAAP isn't a blank check. Like everything else here, the number is in your paperwork. It's possible that GAAP can outlive your negative equity, which was the only reason it was ever there. The moment your payoff drops below what the car is worth, there's no difference left in the middle. If your car is worth more than you owe, the total loss payment covers the whole loan by itself. There's nothing left for GAAP to pay. But whether that costs you money depends on how you paid. Two very different situations wear the same name. If you add a GAAP to your auto policy, you're paying for it every month. It keeps coming out until you cancel it. If you financed a one-time charge at the dealership, there's no monthly GAAP line to hunt for. The cost is already inside the loan, and you're paying interest on it. Some contracts also just stop. For instance, one credit union waiver caps its coverage at 84 months. Your loan can run longer than that. And if it does, those last months have no GAAP on them at all. You're still paying off the charge. The coverage already ended. Don't expect anyone to tell you the day any of this happens. No letter arrives, which is why the cancellation and refund rules are worth reading before you need them. And if you pay the loan off early, or trade the car in, or refinance, you paid for coverage meant to last the whole loan. End the loan early, and you paid for months you'll never use. That part may be refundable. Who's supposed to start that refund varies too. Don't assume it happens on its own. The Consumer Financial Protection Bureau went looking at auto servicers. It found refunds that never got made, refunds that got miscalculated, and one that took 664 days to show up. Ask for the cancellation procedure, then check that the credit posted. All of it comes down to two numbers. You can find both in about 5 minutes. The first number is your payoff amount, not your balance, your payoff amount. Those are different figures. It's on your loan statement or in your lender's app. The second number is a rough market value for your car. Use any standard valuation guide with your real mileage and condition to get this value. Subtract the second number, market value, from the first number, payoff amount. The answer represents the entire reason GAAP exists. If it's 0 or less, there's probably nothing for GAAP to cover right now. Probably. The valuation guide gave you an estimate. If a car actually gets totaled, the insurer runs its own numbers and they won't match yours exactly. So treat your answer as a rough estimate, not a promise. If you get a positive number, that's what GAAP is for. What you do about it is your call, but you can't make that call until you've done the subtraction. One more thing, check whether you already have it. It could be in an old finance contract, on your insurance policy, or built into your lease. GAAP gets sold in several places, and those places don't talk to each other. So you can pay for it twice without even knowing, which, if you've been paying attention, is exactly how this whole thing started. The car is gone. The loan is not. That was never a riddle. It was a description of two contracts, each doing precisely what it promised, in two different rooms. You can read both of them. They're in your insurance app and your loan paperwork, and they've been there the whole time. So the next time a payment leaves your account, you'll know what each one covers, and whether anything covers the gap between them.